think I'm spotted. Okay, so we are now on to deck 9 and topic 9, which is surplus stripping and paid up capital and many other such good things. Anyway, this is the big one. This is, I think, our biggest unit. It's probably our most complicated unit, and so. And as we're going to see, this is where there are some actual traps as well for people that you'll want to be very, very careful of in real life. So without further ado, let's get on to slide number 2. So in this unit, there are 2 important concepts that we're going to be playing around with. One of which is definitely going to be intuitively obvious to you. The other one of which is hopefully going to be intuitively obvious to you. So the first is tax avoidance. And tax avoidance is basically what we would define as the complete elimination of tax payable. And so it's pretty straightforward as a concept. It just means doing something that should not lead to any tax payable instead of something that could lead to tax payable, but achieves economically the same result. The second concept that we have is rate arbitrage. And this basically involves doing something that is economically similar to something that you would otherwise do, but attracts tax at a lower, albeit non-zero rate. What you're going to see in practice is that a lot of what you do is rate arbitrage, right? I think some of our clients in the financial services sector really enjoy that about tax lawyers, that we just basically are walking arbitrage tools, and that's how we think. So you'll get into that mindset very quickly. In this unit, we're going to address 2 significant means of avoiding tax or of engaging in rate arbitrage. So the first of these concepts is a return of capital. And we've talked about this, it's in the handouts, and we've talked about returns of capital in prior lectures. And the idea with the return of capital is that it isn't a dividend. Instead, it's generally a tax-deferred event to the extent that the amount of capital returned is not greater than the ACB of the shares on which the capital is returned. No tax is imposed on the returned capital, but because the ACB of the shares goes down, there is the potential for a greater capital gain in the future if the shares are disposed of at a later time. If the capital that is returned does exceed ACB, then there could potentially be a capital gain when the ACB goes negative. And we're going to get into the mechanics of that in a few slides, so you don't need to worry about that too much right now. The second avoidance technique that we're going to talk about is commonly referred to as surplus stripping. And this is something that has been a concern more or less from the dawn of the Canadian income tax, especially because we didn't back in the day tax capital gains. So it was a very significant concern. What is or is not surplus stripping seems to have broadened over time. John Gilbert and I wrote a paper about this back in 2014, trying to canvass the potential definitions of what is or is not surplus stripping. But I think where we land is that a pretty useful definition of surplus stripping is anything that involves an attempt to extract retained earnings of a corporation through realizing a capital gain instead of paying a dividend. Right. At its foundation, that's what surplus stripping is. It's a very fancy way of saying substituting capital gains for dividends in order to extract retained earnings. So to understand why these are concerns, you don't need to look much further than the current rate schedule, right? The top marginal rate of combined federal Alberta tax on a capital gain at the moment is 24%. So shareholders, if they have no ACB, will pay tax at 24% on an effective surplus strip. And if they do have ACB, they could potentially use that ACB in order to reduce the amount of the capital gain and therefore to reduce the amount of the tax payable further, recognizing that the loss of the ACB may result in a future capital gain, but on a time value of money basis, it's a pretty good trade to have less capital gain now and more capital gain not now. In contrast, as we've gone through in our dividend unit, which was unit number 6, the current tax rate on a non-eligible dividend is 42.30% in Alberta in 2021. And the eligible dividend rate in Alberta in 2021 is 34.31%. So because, as you would see, this is a pretty significant preference for capital gains, right? It's almost a 20% preference versus non-eligible dividends and just over 10% preference versus eligible dividends. So because of this, fairly significant preference for capital gains rather than dividends, and this ability for what would otherwise be capital gains to be tax-free to the extent of ACB, we have to have rules that protect against excessive returns of capital and that prevent, in some instances, the substitution of capital gains for dividends. As an aside, and as I think we're going to see as we work through this unit, all of this is made significantly more complicated than it needs to be because we have different rates for different things, especially because we have the small business rate that's driving the non-eligible dividend rate, and as well because we have the capital gains deduction for small business corporation shares and for qualified farm or fishing corporation shares, which in Alberta just means qualified farm property, basically. Because of those things. And so as a result of having this ability to receive tax-free amounts where you have the capital gains deduction, whether for qualified small business corporation shares or qualified farm or fishing property, you need rules that guard against that specific thing as well. We would probably not need some of these rules, or we might not care very much if our rates for dividends and our rates for capital gains were the same as in the were the same. So if we just had one rate of tax, a unitary rate of tax for capital gains and dividends, which is what they do in the United States. I think in many Nordic countries, that's what they have as well with their dual base income tax. So there would be, that would simplify things quite a bit. We might still need some rules to protect against utilizing the capital gains deduction, for example, in order to extract capital, but it would be a much less serious affair. So were I the king of tax policy, I would probably be looking to have a single corporate rate of tax that I could set at such a rate where I could have my dividend and capital gains rates also be the same, and therefore just eliminate much of the chicanery that we're going to talk about this week and realistically most of next week as well. What I say is, fortunately for tax lawyers and tax accountants, I am completely unelectable for a wide variety of reasons. And so as a result, this is never going to happen. And people who are more electable than me are never going to do this because I enjoy being electable. And so we're going to be stuck with these very complicated rules, and you will get to bill clients very much money to work around these very complicated rules. So if we flip to slide 3, we are now at the place where we have to talk about what paid up capital is. And we've teased this a lot for the last several weeks. And We can't avoid it any longer. PUC is just foundational in applying everything that we're going to talk about in this unit. It's an interesting idea. I wouldn't say it's an entirely uniquely Canadian idea, because it's a concept we stole from the British, just like we did with most of our original income tax system. But it certainly has evolved into a uniquely Canadian thing. And interestingly enough, some Americans find this to be the most complicated part of the Canadian tax system to wrap their heads around. I find that to be amusing, because American tax is generally the worst, and anything that seems complicated by Canadian standards is usually not that bad by US standards. So if Americans are saying this is complicated, it's complicated. So if you're having a bit of trouble with it, just know that you're probably not alone in that fight. So conceptually, what PUC does is the same thing that share capital does for accounting financial statement purposes, and it does the same thing that stated capital does for corporate law purposes. It's essentially measuring the total direct equity contributions to the corporation by its shareholders. So PUC doesn't change as shares are exchanged between old and new shareholders. It only goes up or down when money or property is contributed to the corporation, or when amounts are withdrawn from the corporation as a return of capital. So as a result, in the private company context, it may be that PUC and ACB are the same at the time that the corporation is incorporated, but after that point in time, PUC and ACB can diverge wildly as the shares are passed between shareholders, and ACB continues to increase, generally speaking, while PUC remains constant, right? And to use a really obvious example of this, right? If you actually cared what the PUC of, say, a share of the Royal Bank of Canada was, it would be incredibly different than the ACB of the shares. We're going to see we don't really care what the PUC of a public corporation share is, but supposing that we did, that's a corporation that's been around since the 19th century. It's traded on an exchange in 2021 dollars. The shares are going to be worth way, way, way more than the PUC of the share is, right? Because a PUC is some of those initial shares that are on the exchange have been, issued by way of splits of the original shares, are going to have some laughably 19th century paid up capital, whereas their fair market value, and if you acquired one today, your ACB would be $100-something a share. So it could be wildly divergent as a result of not changing when shares change hands. And so I guess even the point is that even in a private company context, if you don't know that the shares were issued on incorporation and have been owned by the same people since the incorporation of the corporation, it's really dangerous to assume that PUC and ACB are the same. So PUC itself is important because the PUC of the shares held by the shareholder is generally the limit of what we will permit a shareholder to withdraw from the corporation as a tax-free return of capital, or otherwise except by way of a dividend. This is because the PUC represents the shareholder's proportionate share of the total direct investment in the corporation. And we don't want anybody to withdraw on a tax-free or tax-preferred basis more than their proportionate share of the total direct equity investment in the corporation. So PUC itself is defined in subsection 89.1, and it is one of the I've probably said this a bunch, but it is one of the least helpful definitions in the Act. There's many unhelpful definitions in the Act, and this is most assuredly one. Basically, the PUC definition in subsection 89.1 says that the paid up capital of shares is the paid up capital determined without reference to the Act, and then it provides for a bunch of adjustments to this paid up capital determined without reference to the Act, which you have no idea what that is. And so what the courts have held and what the CRA will say is that paid up capital otherwise determined basically means the stated capital of the shares for corporate law purposes. And so the starting point then in determining PUC is to go to the stated capital accounts maintained for shares under Section 26 of the ABCA. And if you're not in Alberta or if you're using the CBCA, the equivalent to Section 26 under the relevant BCA. So implicit in the PUC definition and in the various uses of paid up capital in the Act, there are three things that can have paid up capital. The most important of these things is the paid up capital of a class of shares. So subject to the adjustments in subparagraph B3 of the PUC definition in subsection 89.1, the starting point is the ABCA stated capital account for the particular class of shares. So that is always going to be your starting point. In whether you're determining the PUC of a class of shares, the PUC of a particular share, or the PUC of all of the shares of the corporation, the PUC of a class is always your starting point and therefore the most important thing. And so, like I said, what you would need to do to figure out the PUC of a class of shares is to go to the stated capital accounts maintained in the minute books of the corporation. Ideally, they've been maintained, and just total it up for that particular class of shares. And there's your paid up capital for the class. Again, subject to adjustments, but we're not really going to talk about any of the adjustments in this course. The next most important PUC concept is the PUC of a particular share of a particular class. And so this is pretty straightforward once you know the PUC of the class of shares, because the PUC of a particular class of, a particular share of a particular class is determined by taking the PUC of the class of shares and dividing it by the number of issued and outstanding shares of the class. So as an example, if our corporation has a class of shares called the Class A common shares, and these shares have aggregate stated capital under Section 26 of the ABCA of $100, and there are 1,000 issued and outstanding Class A shares. Then when we divide $100 by 1,000 shares, we get a PUC of each particular Class A common share of 10 cents. So that's how you get the PUC of a particular share of a particular class. And like I said, once you know the PUC of the shares of the class, it's just an exercise in division. The least important concept is the PUC of all of the shares of a corporation. And that's just done by adding up the PUC of every class of shares. So again, once you know what the PUC of every class of shares is, then you know the PUC of all of the shares of the corporation, because it's just a simple exercise in addition. So if we flip to slide 4, we have problem 5 in our handout, and this is a pretty straightforward question that's just intended to make sure that we're all on the same page. So if you were doing this at home, we can now make sure that you're on the same page. So question part 1 of problem 5 is asking, what is the PUC of a share? And so again, Our starting point here is in subsection 89.1, and the puck of a share is equal to the amount determined when you divide the puck of the entire class of shares to which that share belongs by the number of issued and outstanding shares at the particular time. And again, the puck of the entire class of shares is equal to the stated capital of that class determined in accordance with section 26 of the ABCA. So then part 2 of problem 5 asks why puck matters for tax purposes. And again, to reiterate, puck is important for tax purposes because in most circumstances, we will not allow a shareholder to extract more than this amount from the corporation without being deemed to have received a dividend. And we're going to talk at length about how you get to be deemed to have received a dividend. And the reason we do this is because any extraction in excess of the amount represented by the puck of a share is essentially an extraction of retained earnings and not an extraction of capital originally contributed to the corporation. And so proper integration is not achieved if we tax that extraction at anything other than dividend rates. Finally, part 3 of the question asks what the effect of subsection 248.6 is. And subsection 248.6 provides that each series of a particular class is treated as a separate class. So as hopefully you all know, I'm assuming everyone's taken corporate law. If you haven't, make sure you do. I assume it's compulsory at the U of A. If it for some reason isn't, dear Lord, take it. The concept here is that under the BCA, you can issue shares in series. So you can have different series of the same class of shares, which are basically identical in all respects, but they are potentially treated as, for some purposes of the BCA, treated as different classes. And so the Income Tax Act adopts this treatment, and subsection 248.6 deems every series of shares to be a separate class of shares for income tax purposes. So in the context of PUC, what this means is that you have to maintain a separate stated capital account and a separate paid up capital of a class for each series of shares. And so you do not aggregate the PUC of the series into a single class. So if you have Class A Series 1, Class A Series 2, Class A Series 3, each of those series has to maintain its own PUC of a class, and you do not have a singular PUC of the Class A shares because they're different classes. All right, so is everybody okay there? Okay, seeing nobody, we can then go to slide 5, which is part 1 of problem 6. And so in problem 6, we're starting with, before we get to the hypothetical examples, we're starting with some basic problems. So first it's just asking us, well, what is the relationship between the PUC and the ACV of a share? And so like we talked about, for practical purposes, there's no relation between PUC and ACB, right? They both track different things. ACB tracks what the shareholder paid to acquire the particular share, subject to the adjustments in section 53. And it doesn't really matter how the shareholder got the share in determining ACB, unless there's some kind of a rollover provision, which we'll talk about some later in this course, that could apply to cause the ACB of the share to be different than its cost otherwise determined. But generally speaking, ACB is what you paid to get the share, and being agnostic as to how you got the share. Whereas paid up capital is determined under different provisions, in this case under the PUC definition in subsection 89.1, and it tracks a different thing, namely the cumulative equity investment, direct equity investment in the corporation. And so then the problem goes on to say, can these two amounts be different? And yes, obviously they can be different, right? Because if we're tracking different things, then it makes sense. You would expect that over time, the two things that you're tracking separately would be different. That's just common sense, right? So then the problem goes on to say, okay, why are they different? And, there's a variety of reasons why they can be different. First of all, because PUC is historical and ACB is not necessarily historical, right? ACB is only historical, again, going back to the idea that income tax is a transactional tax. If you never do anything with the share and you never dispose of it, you never acquire it, it's just you've always had it, then ACB is historical. But generally speaking, ACB fluctuates because people do dispose of property and they buy a property and they do things. Whereas PUC is historical, right? So that can cause divergences. Second, ACB is what a particular shareholder paid, and so it's determined on a shareholder by shareholder basis based on particular transactions entered into only by that particular shareholder. Whereas PUC averages, right, across all the shares of the class. So, the particular transactions entered into by a particular shareholder don't really matter. It's just a simple math exercise in how many shares are issued and outstanding at any particular point in time. And so, again, just to reiterate for what will not be the last time, where you have shares that are not acquired from Treasury on the incorporation of a corporation, you should expect that the PUC and ACB of the shares are going to be different. So with that, we can then flip into the actual problems that are in part 2 that are trying to illustrate this concept. So in part A of problem 6, in 2010, our individual A paid ACO $100 for the issue of 100 Class A common shares from Treasury. The 100 shares were the only issued and outstanding Class A shares until 2021, when a further 100 Class A shares were issued to BCO for $200. So the problem is then asking, well, what is the PUC and ACB of the Class A shares owned by A and B? And what if the 100 shares issued to B were Class A Series 2 shares? So, starting at the beginning, when A subscribed for their shares in 2010, the shares had ACB of $100 because that's what was paid for them, and they had PUC of $100 since that was the stated capital of the class under Section 26 of the ABCA, and A was the only shareholder of the class. So every one of A's shares would have had PUC of $1 per share and would have had PUC as a class of $100. And so in this case, because again, we acquired the shares from Treasury on the incorporation of the corporation, our PUC and ACB was equal. So that's all well and good. And then we fast forward to 2021. And in 2021, our individual B has subscribed for a further 100 shares, but now for $200. So presumably what has happened is that the fair market value of the shares of ACO has increased from $100 to $200 per share for 100, a block of 100 shares. So basically increased from $1 per share to $2 per share in the intervening decade plus, so that when B wants to buy in and acquire half of the shares of ACO, BCO has to put in $200 in order to do that. So what happens here is that individual B rather subscribes for shares for $200. And so as a result, individual B's ACB in their shares is $200, which is the amount that they paid. And again, being agnostic as to how we acquired the shares. A hasn't done anything. A owned 100 common shares before. A owns 100 common shares right now. So A's ACB remains unchanged at $100. Now, however, where things are going to get different for A is with the puck of the shares, because now, given our puck definition in subsection 89.1, which requires averaging, the puck of each Class A share is now $1.50 per share, which is what happens when you take the $300 of stated capital, being the $100 originally contributed by A and the $200 contributed by B, and you divide that by 200 issued and outstanding shares. So since A has 100 Class A shares, then the total puck of A's 100 Class A shares is $150. B also has 100 shares, so B's puck is $150 as well. This puck averaging is kind of a raw deal for shareholder B, because shareholder B has ACB of $200 and puck of $150. So if shareholder B decided that, you know what, I actually don't like this investment, I'd like to cash out and have the corporation repurchase my shares, then our puck and ACB are divergent. And what we're going to see is that the result is going to be that B would realize a $50 deemed dividend, even if B got cashed out for the same $200 that B initially put in. So pretty raw deal in some instances. And so this is what the problem is driving at when it's asking about the separate series of shares. So if B were to have subscribed for a separate series of shares, in this case the Class A Series 2 shares, then subsection 248(6) would apply, and it would deem that series of shares to be a separate class. So now the result would be that A would own shares for income tax purposes of A class, and that class would have paid up capital of $100. A's ACB is unchanged at $100, so that's fine. And then B also owns shares of a separate class, and so the puck of that separate class is $200. So B's ACB and puck are $200. So now we have alignment between our puck and our ACB. And if B wanted to cash out because B doesn't like ACO anymore, then B could do that without any tax consequences. So that's that part of the problem. And this is something you'll have to think about in real life, is balancing competing interests, like what you see in this part of the problem, is that in a perfect world, you would probably want all of your shareholders to be in, if they're investing in shares from Treasury at different times, in a perfect world, you might want them to all be in different series for tax purposes, so that they would have puck equal to ACB, and it would reduce the amount of tax they would have to pay on various forms of exit from the corporation. However, your colleagues who are corporate commercial lawyers are going to freak out if you want to do that, because again, for many BCA purposes, the shares of different series are effectively shares of a different class. So you may be able to pay dividends on one series of shares to the exclusion of the other series. And so you might have a problem now from an impression standpoint if, for example, a very large shareholder owns shares of one series and everybody else owns shares of a different series. The person who, let's say, owns the majority of the votes and owns all the classes of one particular series can elect directors who will only pay shares on their series. And the only thing anybody else can do about it is sue them and claim that it's oppressive, and that hope that the court applies the oppression remedy to stop that. So your corporate commercial colleagues will say, well, that is not happening. right? Like, we are not going to let that happen because absent having a USA that requires us to pay dividends in the same amount or proportionate amounts on different series of shares, we're going to put everybody in one class and one series, because that way there's no chicanery like this. So it's an important balancing act in the real world, and something you're going to want to think about, this trade-off between puck averaging and not getting commercially screwed. So then we can move on to part B of problem 6. And in part B of problem 6, we're assuming the same facts as in part 1, but now in 2022, individual C is going to purchase all of the Class A shares owned by A and B for their then fair market value of 500. So obviously, B acquires shares of ACO at a very opportune time. So it's asking, what are the income tax consequences to A, B, and C, assuming the Class A shares are not issued in series, and what if the shares are issued in series? And so the magic in this problem, okay, is to identify that puck has absolutely no bearing on the tax consequences of a sale to an arm's length person. And the result is, in this case where you're selling shares to an arm's length person, that's an important caveat. The result is that you have a capital gain. And determining the capital gain is the exclusive domain of ACB. It's just a matter of your proceeds of disposition and your ACB and your selling expenses, and puck is entirely irrelevant. And again, it's useful to identify here, and part of the trick with this problem is to identify that puck doesn't change on a share transaction, except for an issuance from Treasury or a repurchase from Treasury or something similar like that. So what happens in this problem, regardless of whether the shares are of the same series or a different series, is that A and B both realize proceeds of disposition of $250, which is a 500 divided by half. And so the result is that A realizes a $150 capital gain, which is the difference of the ACB of 100 and the proceeds of 250. And B realizes a capital gain of $50, which is the difference between B's proceeds of $250 and B's ACB of $200. So if we're good, that's it for A and B. So the question comes, well, what about C? And so for our individual C, if there was only one class of shares, then C would have ACB in all of the Class A shares of $500 and would have puck of all of the Class A shares of $300. If there were separate series of shares, then the effect of subsection 248(6) is that C would have ACB of $250 and puck of $100 in her Class A shares, and would have ACB of $250 and puck of $200 in her Class A Series 2 shares. Ultimately, C doesn't care because C is a sole shareholder, and there are many easy ways to combine the puck and ACB at this point. So the moral of the story is that if all we're doing is selling shares on a taxable basis to an arm's length person, puck is basically irrelevant, and that's what we're asking you to identify. So any questions so far?
I just had a quick question about 24(8) sub 6.
Okay.
I was just wondering, so for this series, so like if you're treating this series as a class, you're not going to be able to find what basically the paid up capital of that would be in like the corporate minute books, right? You have to calculate it on your end.
Not usually. Usually in the minute books, they will treat the series as a separate class in computing, in maintaining the stated capital accounts, simply because the BCA requires that each series have a separate stated capital account as well. So it should work out for you where it's not going to be crazy difficult to do.
Okay, perfect. Thanks.
No problem. And I guess what I can add to that as well is just that because it's one of those things where you really, for corporate law, stated capital, like it matters and it doesn't. Like, again, it might matter for something like paying a dividend and worrying about whether you're onside or offside the corporate law solvency test. But again, there's no BCA police to come and arrest you if you do that. So generally speaking, stuff that makes no sense for tax purposes, people probably aren't going to do in the corporate law world anyway. So because PUC is obviously much more important. It is basically, PUC is basically the most important use of stated capital. So fortunately, if the corporation has diligent solicitors who are maintaining stated capital accounts, they will be broken out on a series by series basis, although the BCA requires them to do that anyway in most instances. So I think we should take a break now, just because we're at a very logical break point. So last chance for questions before we pivot a little bit on the other side of the break. Okay, seeing none, let's take a break. We'll come back at 3:05 and we'll start digging into some deemed dividend provisions.